Well, good afternoon, investors. Welcome back to our May 17th, 2022 bull sessions. My name is Mark Robertson. I am joined here by two wonderful guests, Kim Butcher, who's a regular guest damsel at the round table and has done a really cool job picking some stocks. Good afternoon, Kim.
Hello, everybody. Hope you're having a great day.
And we had over 80 degrees in Michigan a few days ago, and I suspect, and in fact, Diane is now also from Florida. So you guys have probably had some 80-degree days recently.
It's warm today.
So welcome back to the program, Diane. Many of you will remember Diane as a contributor, as one of our herding cats in the early days of the internet at Better Investing. And again, your contributions were many and greatly appreciated, Diane.
Thank you. I had a great time doing it.
It was so much fun. That herding, I got to pull out that herding cats commercial that we used to use and take another look at it. Because we had volunteers from all around the country, and it was the early days of doing this.
Coast to coast, Alaska to Boston.
Yeah, we should target a reunion or something at some point.
A cruise.
That's approved.
A cruise.
A cruise would work. That would be really cool. All right, so let's go ahead and, I just threw together a quick cover slide here today. One of the things that I do want to talk about a little bit, I don't know if we'll have more questions than answers, but yeah, we've been through a period dating back to the COVID onset of the pandemic and the subsequent recession and all that economic turmoil. And it has basically messed with a lot of stuff, and that continues to be the case, especially what's going on in Ukraine. There's just a lot of stuff going on out there. The stock market has been sliding south, although it does seem to have kind of caught its breath here a little bit. A lot of people following that sell in May aphorism. I think that might not be the best advice just based on the condition of the market and some of the opportunities that we're seeing. We'll talk a little bit about cannonballs and waveforms and harmonics, and just kind of toss around that whole thought. And the stuff across the bottom of the page is just a reminder that this stuff does happen. That picture in the middle is the Tacoma Narrows Bridge, which was very carefully built, but built improperly from an engineering perspective, such that it basically vibrated itself into destruction. And if you ever get a chance to watch the Tacoma Narrows footage, you can actually just watch this bridge shake. It begins with a small wave, and you can watch the entire bridge bend and move kind of like a snake, and it just completely self-destructs. It's from like 50 or 60 years ago, but wow, what a moment. And we are seeing a few stocks doing that sort of thing, and we just have to realize that with the long-term perspective, we can skip the bridge, I guess. And of course, the cannonball, we'll talk about that. That is not Mark nor Ken. And by the way, Ken is traveling, not able to join us here today, and he sends his best regards as usual. That is not a picture of Ken or Mark on the upper right. All right. Here's our standard disclaimer. No investment recommendation is intended. This is an educational demonstration. Everything that we do here is based on the lessons that we have observed and explored, the lessons of the modern investment club movement going on 8 decades strong for successful investing, how to discover actionable investment opportunities, what type of things to think about, what are the major considerations, so the analysis techniques and the methods for building portfolios and taking care of them that have been done by the modern investment club movement over those 8 decades is what we attempt to share here. And the stuff that you hear will be our opinions. Please do your own homework and make your own analysis of any company that you're considering before making an investment decision. If we own a company, we're going to talk a lot about Stryker. I own it. I suspect the two of you also have either owned or currently own Stryker.
For sure, I used to.
Nah, not me.
Really? That surprises me because that's been such a popular stock. No love for Michigan, huh?
Oh no, I love Michigan because I love Dow.
Ah, there you go. All right. Once a month, we do participate in a roundtable that is hosted by the Mid-Michigan chapter of Better Investing. And that generally happens on the last Tuesday of the month at 8:30 Eastern Time. We've been doing it for 12 years. And you both will be glad to know that we actually are back at a relative return, outperforming the market by 6 percentage points now. During this market downturn, it's been quite good. So our actual annualized rate of return for the roundtable tracking portfolio is now 16% versus a market at 10%. So we've actually dropped less than the market, significantly less than the market, and we're grateful. All right, so if you'd like to have a reminder for that monthly webcast, send an email to ncavilla1@comcast.net. Just mention that you heard about it here and you'd like to be added to that list. You will not be inundated with emails. Natalie sends out 1 or 2 a month with respect to that roundtable reminder, and just let you know when that's actually happening. If you have any follow-up questions or would like copies of the slides, or if you have suggestions for future topics, my email address is markr@manifestinvesting.com, and Ken's is also on display there, kcabula1@comcast.net. Please feel free to reach out. All right, ladies, this is kind of the agenda for today. Just real quickly, we're going to talk about that stock market wave thing, go through some Morningstar small companies. You guys were talking about where to go shopping these days and dividends and all that kind of stuff, so we should be able to accomplish that in our traditional check-ins on the best small companies and the Groundhog Challenge. No changes. Herb is still on top. And today we do celebrate a birthday. It's the birthday of the New York Stock Exchange. Now, I've not ever actually been there. I think both of you have actually been at the stock exchange. Is that correct?
No, I know Avi was there.
I have opened and closed both.
Okay, so
And of all times, it was 2009 and 2010.
you're one of the bell ringers.
Yeah.
Yeah, I need to get out there someday. I mean, I've been there. I've not been there in any official capacity, but it's probably time to go back and spend a thoughtful moment. So let's go ahead and get underway.
I hate to say this, Mark, but I don't think anybody can get in there anymore.
Really?
Yeah. Because when I went, because this was right around 9/11, you had to be invited to be able to ring, and you had to be part of an organization, and then you had to go through scanners and security checkpoints in the whole 9 yards.
Well, I do have some friends in low places, but maybe my FBI file would keep me out. I don't know.
I don't know.
All right, just a quick check-in on the Groundhog. I'm not going to belabor it. Herb continues to lead with his Sin Soap and Soup portfolio. He's pulled a couple percentage points ahead of David Einhorn and Warren Buffett. Some of those institutional celebrities are at the top of the list, and they're getting kind of annoying. But we still have quite a long room to run. The monkey from Graham Stephan continues to be annoying. But I did restore the Wilshire 5000 here because Ken was missing it over the last couple of weeks. But a lot of our names are missing on there, at least for now. We hope that's a temporary condition. But it is one of the more challenging markets that we as a collective community have seen in quite some time. And it seems like Ken Hebner is an example. We'll actually look at that in a minute, as an example of somebody who does well in these really challenging markets. And at CGM Mutual. But some very, very prominent and welcome investment clubs in the hunt this year. All right, and Kathy Wood, of course, continues to struggle. You can read, there's generally a daily feature about her struggles in most financial publications, it seems, these days. All right, so let's talk about one of my favorite analysts and one of our favorite subjects. And this one came out from Susan last week. 10 best small cap companies. I think small caps and mid caps are areas of opportunity right now. And you'll see why we like Susan so much. Look at that list of companies mentioned. A number of them are in our best small company portfolio. And a couple new additions there that we'll took a closer look at. The actual link to the article from Morningstar, I'm 99% sure that's a public link. If you have trouble with that, send me a note. But you can actually go take a look at the words from Dave Sekera and Susan Dubzinski, and notice that Boston Beer is here also, one of our current favorites. So here's a quick look at the points of view for the company. A couple of you had written to me and requested that go through the slide a little more carefully, a little more slowly. All we're basically trying to do is represent here the specific individual opinions of the groups of analysts, whether they're Morningstar, Value Line, or the analyst consensus. And so from left to right, I basically put together this chart of how to read it. These are the 10 companies mentioned by Susan, and they are ranked by the combination of our return forecast and our quality ranking, which is basically the projected annual return and the quality ranking here. Basically putting those into an index and doing them by our manifest rank. So from top to bottom, most attractive to least attractive, they all have some merit. There's no doubt, but that's what the actual ranking is. The growth that's referred to here is the top line sales growth for these companies. It's the sales growth forecast for these companies according to the analyst consensus. So you see several of these companies have double-digit or very close to double-digit growth forecasts, and 4 or 5 of them do not. And that's where that middle point jumps in here. This is something that we make quite a strong point about, fairly common. It's the reminder that a small cap company is not necessarily a small company. In some cases, it's just simply a very large company that's damaged. I can remember the day that Ford went from a mega cap to basically a micro cap over a period of approximately a month. So, Ford being a very large company, it became basically a micro cap. So the two things are not the same thing. And that is clearly shown here on this list because Susan is sorting by cap. And we would obviously be more attracted to the companies with the higher growth rates. Again, considering a smaller company to be more typified by a double-digit growth rate or better. So between that, the projected return, the quality ranking, that's the kind of the way we look at things. And then we've included the projected return on value here in the next column. And these are all pretty good. Anything in double digits, again, you should think of them very much like you would think about a projected annual return, a Section 5 result on a stock selection guide. Those numbers should be comparable. And you can see in most cases they are. Most cases, these two numbers are fairly comparable, and we'll be talking more and more about that. The actual math behind the projected return on value is shown right there. We're basically taking a projected return forecast, in this case, earnings before all the financial items. So it's basically cash flow. You can think of it that way, or operating margin. And it's projected. That's the major distinction. That's the major difference between us and everybody else in how they look at things. So the projected pre-tax income or projected earnings in the future before financial items divided by the enterprise value. And the enterprise value of the company is basically the market cap or the stock price. We actually have modified the formula to be total liabilities, not just total debt. And that really works awesome. And then we subtract out the cash that's actually in the company's wallet as part of that. So again, anytime that you're seeing numbers that would be attractive to you as a projected annual return in Section 5 of an SSG, that would also be true with this prove. And again, they should be comparable. They're different. There's probably something that you want to explore carefully. All right. The RSI, as it says here, it's the relative strength index. And again, we would be more interested in companies that are lower. The lower the reading, the better. For example, here's Hanes brand. That is suggestive that the company is oversold. And fairly interesting company, mostly in underwear, I believe. And again, that would be the more attractive ones there. So anything 30 or less kind of captures our attention. We want to make sure it's something that's not already on a watch list, and you don't want to gauge the opportunity. The value line low total return forecast, that's just simply from their annual rates projections. And in our case, we do correct it for the change in date and the change in stock price. So those are current numbers, at least as of the time of the chart preparation. Higher is better, unless it gets too high. And we do find this one in the Detroit area to be very interesting, that Rocket Mortgage, with all the challenges going on in that particular industry, that one actually shows up fairly attractive under the current conditions if you can grit your teeth and get through whatever it is we're going through right now. That's part of what Diane was talking about a few minutes ago. Times are tough around the globe, and it's kind of tough to figure out where the end in sight is. The other two columns are longer term situations with the Morningstar analysts and the analyst consensus. And that's simply comparing the current price to what they calculate to be a fair value, which would basically be the most reasonable selling price for the company. So anything below 100 is theoretically on sale. So you can see why Susan is attracted to these 10 companies. With the caveat, just like everything else we know in investing, anything that looks too good to be true, like this Altice USA, anytime you get this low, 36%, that gets to be a little bit dicey. Could be good, but it's something you want to be a little bit careful with. So it's like when you see a PE number that's too low, or a forecast that's too high. That's why these are color-coded in yellow. They're potentially too good to be true. You want to be careful with those. And you can see that the analysts do not agree with these last two. They're probably fairly sparsely covered, and maybe some analysts that need to update their homework, but you can see that there. Then the last column, again, we don't know exactly. This is something I've promised to do some research on and do some confirming calculations. That's the analyst consensus forecast over the next year for total return. Again, this Millicom International, which I did add to coverage at Manifest, has a lot of tailwind behind it. Think of it that way, headwinds versus tailwinds. The higher numbers mean that the near-term outlook is maybe a little bit above average. And those numbers are also broken out down here. Any of these companies jump off the page, either Diane or Kim?
Talking about energy, I'll probably go look at the oil and gas midstream of Entranis Midstream.
Yeah, we didn't have that in our coverage, so we added it, and it'll be available for dashboards shortly. But
I am currently a shareholder in Boston Beer.
yeah,
One thing I'd like to say about, I've been a longtime Morningstar user and the fair value approach. And I think you have to be patient, because this is definitely a case where someone has gone in to analyze what a company, what a reasonable buyer should want to pay for this company, and yet the market doesn't see it that way. And so oftentimes the company just has to keep doing what they're doing until they can prove the market wrong. And so these fair value numbers are not always off the wall, but they may require more time than you're willing to be patient for.
yeah, that's a good segue to our chart when we talk about our best small companies, because I think the same thing applies, Diane. Yeah, I would agree. And with the other cautionary note that if you are dealing with a fairly early stage or emerging company, that does tend to drive a lot of these analytical firms crazy. It drives us all crazy, but it can sometimes take them a long time to catch up with a realistic outlook for a company like Tesla or others, but Tesla comes to mind. All right, let's go ahead and keep crunching along, because that does lead us into these. A number of Susan's favorite companies are on our list. They have been sluggish for some time. I thought I had changed this around a little bit more than I did. We have seen a little bit of a rally in Superior Group. Few more green numbers on there, but we do continue to suffer. There's a full-on bear market in the Russell 2000 growth, which is kind of the playground that many of these companies would hail from. But we do see a little bit more green toggling over here. I'm noticing the number of, ones, twos, and threes. Some of these are actually looking a little bit better. So, the real question is, between now and Halloween, will there be recovery in a company like Sharps Compliance or iRobot? Came home last night to find our iRobot chasing our dog around the house last night. Yeah, whether the catalysts are there in time between now and Halloween, but over the long term, Boston Beer is a big one. We are also shareholders, Diane. A lot of faith in that company going forward. I like Green Brick Partners going forward. The one that
I
stumbled.
also own Green Brick. Not a lot. Just enough to follow it and be interested.
Yeah, Matt Spielman has covered that one exceptionally here at on the forum, and it's just a good management story, I think. Car Gurus. Go ahead.
I've been following let me see, where is it? The Southern Missouri Bank Corp. I went into the 14A filing and I found out one of the executives he bought $1 million worth of shares, and I think his price was like $42.05.
Okay.
So that makes me think, because right now it's like, I think at a 1.3 a book value. It's probably come down now, because I think when it was in the 50s, it was 1.3 a book value. So I've been looking at that and doing some more research on that.
Yeah, and Diane was mentioning before we got underway here that a number of the regional banks, again, are showing pretty good strength. And you kind of see that here with these companies kind of in the middle, and with the behavior with rates. And I think when Ken comes back, we'll do another one of our regional bank screening episodes to see what we can see.
We know Ken likes those.
Mm-hmm. And then just to reinforce down at the bottom, those are current prices for Green Tree, which China continues on a lockdown. I think that was, at least in the short term, a wise decision to get away from that. And eHealth continues to struggle. It's down dramatically from where we changed our mind and replaced it with Pachira up at the top of the list. So we're glad we did that. That's what accounts for this outperformance of the blue versus the traditional red. So again, many companies that Susan featured were also in our list, so we hope she's right. All right. One of the companies that jumped off the fund manifest as I was doing some quick updating here, and what I was looking for specifically was funds, whether they're exchange traded funds or mutual funds, with high return forecasts. And so what you're looking at here again is that projected annual return, weighted projected annual return for the holdings in the mutual fund, and the projected return on value. And we talked here a couple of weeks ago, maybe a little bit last week, about how some of the funds that have really suffered and lagged had low projected return on values a couple of years ago, so low that we questioned them at the time. And in this case, the opposite. It's kind of the opposite situation. This is pointing to opportunity in some of the smaller company funds and the medium-sized company funds, and a couple of old longtime favorites. Oberweis is a fund out of the west side of Chicago. Diane actually has some experience with the company. Aurora, Illinois, yeah. And Diane, do you want to describe your exposure to Oberweis and your thoughts from 35,000?
I worked for a brokerage firm, and Jim was in charge of the Aurora office.
Okay.
And so on occasion we would go out there, but also since I was in charge of a lot of the mutual fund operations, I was involved and went to all the annual meetings and we talked about how, but this was for Oberweis Emerging Growth Fund. They have since his son has been added as an investment manager, they now have quite a few more funds, as evidenced by you also have the micro cap here and the small cap. But they had, Jim's philosophy was called the Oberweis Octagon. And there were 8 points that they looked for in a growth company, not dissimilar from the kinds of things that we look for at Manifest. But that would be something possibly interesting to look up as the Oberweis Octagon.
Yeah, and I would point out that the Oberweis, both Jim and Jim Jr. were pretty active supporters of the chapter there in Chicago. Made presentations at a number of the investor fairs and that sort of thing. So I've actually crossed paths with both of them, so that biases me a little bit. But one of the things that I like here is the second one on the list. Here's that reference I made to Ken Hebner. Right now he's kind of knocking it out of the park, and he's got this huge number here for prove. But over the long term, this has been more typical. And again, he's been a groundhog champion 3 times or 2 times previously, and those were also during fairly challenging markets. So for whatever reason, he appears to have a knack for investing in challenging markets. But again, number 2 there, Oberweis, 17%, 16% on the par. Could be some fairly interesting things. And notice that they have a positive, a market outperforming over the last trailing 10 years, and you can see it on the graphic down below. And they also do make dairy products and ice cream. In fact, I believe the dairy is pretty close to one of their offices, if memory serves right.
Yep.
And so Oberweis, I think, is nationwide. I know that it's definitely throughout the Midwest. So watch for it the next time you're in the store. It's good stuff, no doubt about it. And I'm always finding lost pounds by indulging myself with some of their product. Notice the track record here. I have compared it to one of our other longtime favorites, Brown Capital, small company. And Brown has actually suffered a little bit over the last year. And part of that is their avoidance, their agnostic admission about financial sector companies. So that would have bolstered their fall a little bit, but I suspect they don't care. Here's a look at some of the tickers that are in the Oberweis Microcap Fund. You can see that Morningstar likes them. They do have a solid track record. And from top to bottom, there are some interesting companies there that might be worth exploring. Here's one that I would challenge the audience to sink your teeth into and try to figure out exactly what's going on here, because I took one short run at it, and I can't find anything wrong with the numbers. Which suggests that they have an interesting capital allocation opportunity, or at least driven opportunity. And one of the things I am watching with some of these leading managers is they are investing in a lot of these higher projected return on value companies. By the way, do the same thing for Occidental at Berkshire Hathaway. Same thing is true there. They have this huge projected return on value, which is probably related to some very compelling capital structure decisions over time. So from top to bottom, again, you can see that these two in general do line up fairly well here, but some fairly interesting companies. I went looking for this number 4 slot, trying to figure out if we could cover it or not. Turns out this company was recently purchased by Stryker. So it no longer exists as a public company, except as a part of Stryker. So that's a little bit of foreshadowing, because we're going to talk about Stryker as we close here today. But Jimmy Oberweis was in the Vocera communications stock when it was still actively traded. Okay. Any other comments on there, or things that you're curious about, Kim or Diane?
A lot of tickers to investigate.
Yeah, a lot of tickers to investigate, and hospital systems have to be purchasing it from Stryker due to the fact of HIPAA laws and all that, I bet.
Yeah, my understanding, and I've got a slide here that shows just the 35,000 foot view. And by the way, thank you to all the nurses that may be in attendance or people that you know are nurses. I have 2 sisters that are nurses and a number of other family members. Kim served for many years in labor and delivery, I believe.
Yeah, 30, I think it's 30, 32, 33 years labor and delivery, 1 year of intensive care, and 5 years of home health care for peds, which when I started that, I didn't realize that was a psych job.
Yep. Well, we greatly appreciate the nurses in our lives, so thank you.
Happy to help.
Yep, and so here, as I was trying to find information, I couldn't get a hit on the company name or the ticker, or couldn't find the ticker, and then I discovered that this was the case, that Stryker had actually bought Vocera fairly recently. And Oberweis must have seen some potential in what this company offers, and we can think about that as we dive into Stryker in a few minutes. Here's our weekly chart that we very commonly put up at Manifest. You can see that the green bar has dipped down below the blue line, so we will be creating a little bit of white space. Don't know how much and for how long, but as we predicted when the value line analysts caught up with their homework assignment, that red dot has risen to a relatively high level compared to the last 2 decades. And again, just as a refresher, that red dot is basically the same thing as if you took the companies covered in the Value Line Standard Edition, did your own stock study, and then averaged the results. The only difference is that the Value Line uses price to cash flow, but they do everything else. It's in a very stock selection guide, similar mode. And so what that is basically saying is you should be able to find a few more stocks on sale these days with the way the market has sagged. And let's hope that red dot doesn't continue going too high. But there are some compelling opportunities. I think many of them are found in the smaller and medium-sized companies right now, but there are opportunities, especially in technology, all the way up the spectrum. So that's our quick reminder as to what's been going on. Just some other snapshots of things that are happening. Mr. Kramer possibly signaling a market bottom with suggesting that people sell losing stocks. And everybody likes to pick on Jim Kramer, but as those of you that have been around, there's a lot of bull veterans that have been around for the last couple of years. We pointed out that his pandemic portfolio was absolutely a showstopper. So if you want to go back and check that out, he really did well last year with his stock picks related to the pandemic opportunity.
Mark, I've been watching, the last couple of weeks because I every day, don't follow the market, but I've been trying to figure this out. And what he's really been focusing on is earnings and quality. And so it's not just so much about they're losing. You don't want to sell a losing stock if it's a solid company, unless you're doing it for some tax purpose. But he's very clear that this is not the market to be buying companies that don't have earnings.
Yeah, and I think he's actually taken a few shots at Kathy Wood for that precise reason, understandably, along, with many others. In that insert on the right there, that's one of those companies. Carvana is fairly young, if you want to think of it that way. I'm not even sure how strong their earnings are yet. I think they have some positive earnings. But the reason I put it on here was just this notion of fear amplifying the magnitude of some of these excursions. And it's something that Ken has talked about a number of times, and that's what we're going to talk about here for a few minutes. The value of these companies doesn't move around nearly as much as their price. I think that's what you're getting at, Diane. That the price going crazy is simply an opportunity in many cases to either buy or sell, but in this case, buy. And that's where opportunities come from. Here's another one, Dentsply Sirona, because we had mentioned this notion of patients that have deferred things, and I think I confessed that I ended up with some oral surgery, thanks to me deferring some stuff longer than I should have. And I'm not alone. There's lines forming at dentist and doctor offices across the country, and I think that these type of companies, including Dentsply Sirona, which showed up on our screening results recently, are some interesting areas. But there is some weird stuff going on. And notice here, this guy took a job and quit it 2 days later. So just be aware. Again, last week we pointed out that this slide captures some of the disruption in a fairly special way. Americans are not slowed down on buying things at all. The slope of this line up here is actually like that versus this slope over here. At the same time that there's obviously a global component which is probably approaching economic recession at this time. So while we're taking off, they're not.
I heard something about consumer credit card debt in the last month has been going up. And this is, of course, not a good time to be adding on debt if the Fed is really going to be raising interest rates.
Yeah, it's been taking off for years, obviously, with some of the way that credit cards are used. But yeah, it's incrementally taking a step up for sure. Not necessarily the best sign, certainly an indication of some of the economic challenges faced by many. All right. So here's what I kind of wanted to talk about for a few minutes. And again, we might end up with more questions than answers, but this is kind of my look at the conditions of what's going on. And it really is the cannonball moment from a little over a year ago, 18 months ago now, following the pandemic. And I tend to think of the stock market, and I'm not an Elliott wave guy, if you're familiar with that stuff at all. But I do believe that if you look at the market over the long term, it zigs and zags, but it does tend to follow a, up and to the right trajectory. But you end up with these moments where there's a disruption, an event, that type of thing that we had back with COVID back in this time frame, and it was massive. I mean, this dive down here is among the worst in stock market history. And then I do think that much like if you do a cannonball into a swimming pool and you notice the waves and how they go out and they bounce off the walls of the pool and they come back. And when they run into each other, they kind of combine and add together. And you end up with, this disruptive series of waves on the surface. And I think we're kind of going through that. And, if you want to talk about the job, I realize I was pretty rough on the Fed a few weeks ago. I still hold that opinion. I think that they watched some indications that they should have acted sooner and not as step change incrementally as they have been, or how much they threatened to do. It should have been sooner and smaller. And because I also believe that interest rates did need to go up, but not all at once, because then you're basically just asking for another cannonball. So I do think this is kind of the situation we find ourselves in, and it should basically create opportunity, because think back to what we were just talking about, how the value of many of these underlying companies really doesn't change that much. And you should be presented with pricing opportunities to buy and to sell. So what do you think, Diane? Does that capture any of the... I mean, you hang out at the money show. Should we put this on a flag and run around at the money show?
I like that, what is it, 15, 20-year chart. You've only got 2.25 years here.
Mm-hmm.
And so all the ups and downs really get more accentuated. But let's go back to, I forget, it's the big chart that has, the 20-year returns or whatever on it. And half of these things, it really smooths itself out.
Yeah, I'm with you completely. I mean, you're looking at just a very small slice of this picture right here.
But if you can believe this chart, it makes it easier when you're at those low moments to confidently walk in the water as opposed to having fear.
Yeah, and as opposed to having fear, for me, it's like lets me get greedy. There's blood on the streets now. What should I go look for?
Yeah, I'm with you
Bargain
guys.
shopper, you.
I mean, I
What's
can
that?
go ahead.
What'd you say, Diane?
I said, you bargain shopper.
Oh God, yes.
Well, you know, and you guys can elaborate on this, but I mean, I have met with SEC officials and some state securities regulators, and they simply can't believe that, you know, when we have a moment like we had in 2008, 2009, you know, this one right here, and then following the depths of that COVID plunge, not recently. I mean, I'm talking about a community of people that is legitimately going shopping. You know, we were gritting our teeth. I mean, I admit some of the discussions that we had back in this time frame, you had to grit your teeth, but you could also go looking for opportunity. And our community thinks differently. When everybody else seems to be afraid, when the average investor is fearful, you can basically count on people within the better investing or manifest investing community to be shopping. That's kind of cool.
That's knowledge and experience, and we've been through a few cycles, and we've seen success. You know, you Mark, and what you've offered, and what Better Investing has offered, has given us a foundation to recognize. Just because somebody says it's a time to buy, do more research and due diligence and find out whether or not are they going to meet the criteria you can accept for growth and quality. You know, everything should be growth and quality.
Yeah, and I've been asked a few times, is there, you know, what would trigger you to become concerned and to perhaps not go shopping? And the answer to that is quite simple. If you have a downdraft like the one shown here, the white space that's shown here, and this up here doesn't happen, that's a whole new ballgame. I mean, if these red dots stayed down here in this area while this was happening, that would basically mean that the fundamentals and the expectations for all those companies are falling apart. So I would be concerned then. So, you know, when the market drops and we track the fundamentals, we basically are tracking the value of companies on a fairly steady basis. As long as that continues to be true, I'm going shopping. I'm shopping now. All right. So let's go
If you're
ahead
an
and
investor, you always want to be paying attention and shopping. Sometimes it gives you an opportunity to improve the quality and growth of your forecast as some of your older holdings perhaps start slowing down. So I'm always curious about, you know, who's on the leading edge and where are the growth spurts going to be coming from, just to improve my portfolio.
Very true. All right, here's another, this is a symptom of the situation of a cannonball. You know, the cannonball that happened. And I can remember shopping for a new floor back around this time frame. And we obviously stayed away from the full hardwood option. But I can also remember the guy standing there on the shop floor saying prices are never going back to where they were. And I said, you could be right, but I don't think so. And it took all of a couple of months for them to return basically to where they were. And there's your shockwave in the pool. I mean, here's the down, here's the up. That's a post cannonball effect. And you know what my prediction for the future is for lumber prices? They're going to fluctuate. I think I'm right. All right, so there's that one. And then Barry Ritholtz came up with this one also, that we don't try to predict the future. We try to lay out a vision of what, you know, might make sense based on studying the company fairly closely and understanding the business model and that sort of thing. And I included this one because Ken doesn't like the word probabilistic. So I'll probably use that a number of times in future presentations, but this is straight out of Barry's stuff. And again, this is following the Kentucky Derby. I love the selfie. And the solution is always going to be find a good horse and stay on it for as long as it makes sense to do so. Any thoughts on that? Are you familiar with Berigny at all?
I've heard the name, but it's been a long time since I've seen it.
Yeah,
I've never heard of it.
they're headed by Laszlo, and I need to go back and just see what's there. But they do a lot of economic type stuff. And maybe some future fun for a future bull session.
He used to be on a lot of Barron's panels with Gabelli.
I remember that. I do remember that now that you mention. And I think he was probably on Rukeyser too.
Oh, I'm sure.
All right, so let's talk a little bit about Stryker. I don't think it's a stranger to many of us here, either from time in the hospital using their products. There might even be a few replaced joints. I have a hip joint that's becoming more of a candidate all the time, and I know people with knee replacements and that sort of thing. This is a company that not so long ago was number one in our most widely followed stock in the Manifest 40. That's what the comment up at the top is about. Apple has not always been number one. It's been number one for a long time. But before Apple, Stryker was that company. The image there next to the nurses is Homer Stryker. Founded the company back in 1941. Operates out of Kalamazoo. And they make all that stuff for joint replacements. They make the vast majority of the number of cots, the emergency cots that are in stretchers, that are in ambulances, and a whole bunch of hospital beds and other things. What am I missing here, Kim? Uh-oh, did Kim have to get away?
I don't know. I don't know their product line very well.
It's mostly, there's a bunch of smaller products in hospitals, but the knee replacements and the hip replacements, and most recently the spinal stuff that they've been doing is even more prominent. Here's a quick look at the value line page. You can see a fairly nice price pattern from left to right up at the top here. And I'm actually putting together a presentation for the Dallas National Convention that's going to attempt to beat our 60-second stock analysis using just this box for a number of companies. I'm finding myself really drawn to that box for reasons that we all understand from the original days of the stock selection guide, when we concentrated pretty heavily on the top line, the characteristic of the top line, and then not the ultimate bottom line of earnings, but some form of operating earnings farther up the food chain. And the pre-tax, the same stuff that's involved in the projected return calculation. So there's a quick look at that. Here's a look at that situation in a current stock analysis. And you can see why Up Straight and Parallel, very attractive company. By the way, they would refer to themselves, I was actually discussing with a technician who worked for them not too long ago. They think of themselves as deployed technology to improve people's lives. That's what they think of their company as, and I think that's commendable. Some good stuff. This is actually inspired by you, Diane. Diane wrote a couple of articles for Better Investing back, about 25 years ago?
Yeah.
Where she encouraged us to look at the longer term perspective for a number of companies. I remember you did one on Dana. And this is just an interesting way. We've done a little bit of that here at Bull Sessions, and I just thought we would take a shot at another one. And so what you're looking at here is the sales graphic all the way back to 1988. And what are your thoughts looking at an image like this, Diane?
I love it. I mean, this is how you can become a buy and hold investor when you find that piece of gold.
Yeah, and I think you can definitely see that early growth stage, where we had, let's just call it
in the late 80s there.
Yeah, all of this in this range. This growth rate here is probably 15 to 20%. And then they had this moment. As a shareholder, you want to understand that moment. The answer is right here. They doubled
Probably an
the size of the company.
acquisition.
Yeah, it's an acquisition. So now you've got to look at that company a little bit differently. And so they basically set off on this long-term, very positive, but maybe 12 to 15% growth rate over that next decade or so. They took a bit of a pause after the passage of the Affordable Care Act. And that's because of the deferred stuff that went on back in that time frame. And then we had that same thing happen again with the pandemic. That's what I'm talking about with the dense glycerona and the medical device companies and all that kind of stuff. But you can see this company is still cranking along at a pretty good rate of 7 to 10%, even as it's gotten larger. Here's a look downstream at the earnings. And again, the earnings are going to be more disrupted. It's pretty obvious that the Howmedica acquisition created this moment. So as a shareholder, you could understand, what are we buying? Why are we buying it? What are we doing here? And could possibly have held. By the way, we have held Stryker in our family since 1994. So we've been shareholders, and then we bought a bunch more, I want to say approximately 10 years ago. So I'm with Diane. I like the graphics. The pothole, Pete, on the thing is just pointing out that, with the Affordable Care Act, we did run into, some discretionary deferrals, that sort of thing. And then we had that same sort of thing with people being in pandemic lockdown here. So from a long-term perspective, it's pretty hard to argue with up, straight, and parallel, especially when you can make that side-to-side comparison and understand some of the zigs and zags. Anything else on here, Diane, that we should point out?
Well, the longer you hold it, I mean, we've talked about this, is that when you have performance like this, when you go to think about, oh, I had a bad year, should I sell? I mean, now you have to think about how much you'd have to pay in capital gains taxes, rather than trusting that, this could be a temporary thing and nothing's changed in management to make me think I shouldn't keep riding this horse.
Absolutely. And here's some of the facts and figures. Going all the way back to 1988, the dividend adjusted, split adjusted share price was 59 cents. It's now at 236, 237. So you're looking at an annualized return of 19% over that time frame. This was in the roundtable portfolio, purchased somewhere back in here. I'd have to go back and look, but somewhere back in this time frame. And I think we regret we sold it at some point. It was one of the original stocks chosen for the round table. And then you can also see the fairly natural PE characteristic or trend for a company as it matures.
I mean, going back to Peter Lynch, he always talked about finding that 10-bagger, and you don't need a lot of them, but you need to have at least one good one. And so something like this that really sets a gold standard, you don't want to pull the trigger and sell too quickly, because it can be really, really hard to find another gold nugget.
Well, Mark, I wonder, right now you have where you add up what the quality is and what is it, the quality and the proof, to see if it's a core holding or not.
Yeah, the financial strength, the earning stability, and the quality.
Well, I wonder if you went back and looked where you bought it and then when you sold it, if you can, to see what those numbers were, to see if it would have showed up that it should have been a core holding.
Oh, I am absolutely certain it was a core holding through that entire time frame. But I made a note. I will go back and check. We can take a look. So that's what 19% over the long term looks like. By the way, these right here to me is a picture of optimism and expectations. Keep in mind that they added Howmedica right here. That's why there's no PE. The PE kind of went away. They came out of that with elevated PEs. That's just a sign of / respect and optimism for the company, doing very well. This little depression right here, that's the Affordable Care Act. And the temporary, it was over a period of years, but the temporary impact that had on the company. All right. Here's the full current day analysis. Basically looking at a 7% growth rate. Could argue for 8% or so, for sure. A projected net margin of about 22%. A PE in the mid-20s, which is certainly reasonable based on that picture. Gives you a return that's definitely in the solid hold range at 10% or so. When you take a look at their total liabilities and their cash on hand, you come up with a projected return on value of about 8%. That reconciles nicely and suggests that that PE is pretty reasonable for the company. Very high quality rating, very high core holding. A little bit of a buying opportunity with the recent setback. They were trading fairly close to a 52-week low not too long ago. You can see that whatever money they have borrowed is at a very attractive interest rate of 2.5%. You can see that they were fairly close to a 52-week low not too long ago. It's been a couple weeks. And fairly decent numbers. Now, Morningstar is a little bit less enthusiastic. Still like the company, a little bit less enthusiastic about the expectations. I would expect the Morningstar fair value to be ratcheted up in the not too distant future, but all pretty good patterns here for this particular company. And a good Michigan company. All right, so we're almost up on an hour, and I just wanted to go a little bit crazy here for a minute. You guys have heard me talking about optimism for some of the technology stocks and the QQQ positions specifically. And I had made myself a promise. This is actually a triple leveraged. Now, I'm doing this because Ken's not here. Now, none of you can tell him that we talked about this. So Kim and Diane, are you sworn to secrecy here?
Absolutely.
I don't know what you're doing.
So this is absolute lunacy, but it's also conviction. And let me explain why. What you're looking at is this is actually a mutual fund. It's an exchange traded fund. I don't recommend that you do too much with this. As I have admitted to many of you, I do have a core portfolio of stocks that's full of stocks like Stryker, but I also have a slice where I play. And we admitted last week that I played with a VIX investment that didn't work out very well. Well, here's another. This is another playful moment, and what this triple leveraged fund basically means that they actually only hold 1/3 of the shares in actual companies, and they actually have borrowed the rest. So it's leveraged out the wazoo. It's extremely volatile. It's intended to, if the NASDAQ goes up 5%, this fund will go up theoretically 15%. If the NASDAQ goes down, the QQQ goes down 5%, this will go down 15%. Everybody with me so far? All right, so I basically had made a promise that when this exchange traded fund became oversold, basically down at this 30 level that you see here, when combined with, again, it looks, if you take a look at QQQ at Manifest, it's got all those companies that have been beaten up, so it's got a fairly high projected return on value and a par. It's near the top of the list, but I wanted to watch for a time when apparently some of the institutional traders that follow this company are back and the volume is actually higher. When you look, you can't find a time when the volume was quite as high as it is right now over the last several months. So you basically have people that are involved and being oversold and it looking fundamentally okay. Well, I even took it a step further. I went and bought a January 2024 call for 40 so I'm actually quadruple leveraging this baby up. So I've had it 4 days and I'm up 40%. And that it's playing around. So again, this is pure speculation, but it's also conviction, because I really do believe that the companies that are at the top of that list in the QQQ at the NASDAQ, there's a number of companies there that are quite oversold. And just thought I would toss that out there. If you have questions or if you'd like us to talk a little bit more about this type of stuff, including some of the long-term options. I don't do short-term options, by the way. I always use the long-term. They actually refer to them as leaps. And I know you do a little bit of this, Ken or Kim.
I was going to say, full disclosure, Mark and I did not, we discussed this, but I'd already done it. I decided to do the same thing he did, but mine is for until January of 2023, not 24.
Okay. Yeah, I like
I look at the point and figure charts, and I was like, oh, this is in the big time buy. So I was like, okay, let's see if we can play with it a little bit here and see what happens.
So I did this with a portion of my trading portfolio that I can afford to lose, but so far it's working out. And again, I just think that if you're shopping for companies, that it's a good area to go shopping for companies. I'll probably convert the stuff now keep in mind that this can go away in an afternoon or morning or between the close and the opening the next day.
And it can go up and go down in the same day.
Yeah, and we've had a few of those days here lately.
Oh, yeah.
So it's kind of weird. The other reason that I bring this up, and this is something I want to get permission from Hugh to actually show you guys sometime. You've heard me talk about it, but Hugh also will use options fairly carefully. And again, I don't use them a lot. I do a little bit with covered calls and that sort of thing. But Hugh has actually used these long-term appreciation, they call them leaps, these long-term options a number of times. And the thing that he did with Walgreens a few years ago was just off the charts amazing in terms of how we look at companies. And it's an interesting story. So if you'd like to hear more about that, send me a note in your comments and we'll talk more about it, because again, it can be for an informed investor. And again, you don't have to do this is an extremely high risk strategy here. I'll even call it a tactic. It's not a strategy. So good, clean fun. Here's a reminder that we do put all of these sessions on YouTube. Just go to YouTube and search on Manifest Investing, and we would love for you to subscribe. That way you will be notified anytime new content is added. I do have another short to add after the session that Sean wants to talk a little bit about inflation. And of course, you see the roundtables and some of the other educational sessions that we've done. This one on celebrating workhorses is priceless from our St. Louis session. And with that, we'll end with a picture of a squirrel, because we haven't done a squirrel in a while. And speaking of St. Louis is known as the home of the rally squirrel for the St. Louis Cardinals when they won the World Series a few years ago, from a squirrel that actually ran across the field. So this is just for Ken. It's the double wave with the squirrel. The squirrel will probably be back. Any closing thoughts, Diane?
I love the squirrel.
And Kim?
Thank you for having me.
Yeah, thanks for having me too.
Yeah, thank you both for chiming in and for not telling me how insane I am on the TQQs. I want to get Christy's thoughts on it someday. All right, so with that, let me check and see if there's anything large in the question box. A couple people admiring their situation or their groundhog positions. Does Value Line take into account inflation? Not sure exactly how they would account for it, but yes, I think they probably do. Would you initiate a position in Stryker now? I think I would wait for a slightly higher return forecast, but it's pretty close to being in the buy zone. All right, that looks like we've got pretty much everything covered in the questions box. So again, thanks, Kim and Diane. And hopefully my cannonball wasn't too disruptive.
Nah, you
Or
want to keep us on our toes all the time.
distracting. I can't wait to hear what Ken thinks of some of this stuff. So safe travels.
Thank you.
All right, good
All
hunting
right.
out there, everybody.
All right.
Take care.
Thanks a lot,
Thank
Kathy.
you.